Tesla's stock is at a real crossroads right now. So today, we're going to dive deep into a professional technical analysis to see exactly what the charts are telling us. Is it a buy, a sell, or a hold? Let's find out what the pros are really looking at.
Okay, so let's get our bearings. This snapshot from the analysis shows Tesla's recent price journey. You can see all those big swings, up and down. That's the turbulence, the chaos that we're here to make sense of today. And this number right here, this is our anchor point for this entire analysis, $433.72. Every single indicator and signal we're about to look at is based on where the stock was at this exact moment.
To make sense of it all, we're going to break this down into 5 steps, just like the report does. First, we'll get a feel for the current price action. Then, we'll look at the short-term warning signs versus the long-term signs of strength. After that, we'll pinpoint the key price levels to watch, and finally, we'll see how it all comes together into an actual trading strategy.
So let's kick things off with part 1, the current price action. Before we can even look at the signals, we need to understand exactly where this stock is standing right this second.
So the report first points out a pretty significant recent drop, right? Over 3%. But, and this is a big but, you got to look at the context. Take a look at that 52-week range from $214 all the way up to $488. Even with this little dip, the stock is still trading firmly in the upper half of that range. That tells you the bigger picture has been pretty strong.
All right, now it's time for the stock's health checkup, as the report puts it. And like any good checkup, we're going to start by looking at the potential problems, the indicators that are flashing some short-term warning signs.
First up are moving averages. The easiest way to think about these? It's like taking the stock's pulse. The short-term averages tell us about its immediate health and momentum, while the long-term ones, well, they show its underlying condition over months. And this is where we start to see that short-term struggle. The current price of $433 has actually fallen below its average price over the last 5 and 10 days. And when a stock is trading below its own recent average, that's often seen as a bearish or negative sign for its immediate future.
So what does that really mean? Well, simply put, the momentum for right now is negative. The stock is kind of fighting against the current of its own recent performance, and that is the first major warning sign in this report.
Next up is an indicator called the MACD. Just think of it like a momentum gauge for the trend. It's going to tell us if that downward trend we just saw is picking up speed, or maybe if it's starting to run out of gas.
And yeah, the diagnosis here is pretty clear. A negative MACD reading confirms the weakness we saw in the price. It's basically another system check that's flashing a warning light, telling traders, hey, be cautious in the short term.
But hold on, that's only half the story. The health checkup in this report also reveals some very positive signs, especially when you zoom out and look at the bigger picture, the longer-term potential for the stock. Now we're kind of looking for signs of exhaustion. Are the sellers who have been pushing this price down, are they getting tired? That's what tools like the stochastic oscillator and the RSI are designed to tell us. They check if a stock is oversold.
Okay, now this is where the story gets really interesting. Just look at this data. 2 of these key indicators are deep, and I mean deep, in oversold territory. A reading of 0 on the stochastic RSI, you literally can't get any more extreme than that. This is a huge signal that the recent selling might have just gone way too far.
And this is a key bullish signal from the report. An oversold condition is often compared to a coiled spring. The downward pressure has pushed it down so far that it might be ready to bounce back up, and with some serious force.
So we have these conflicting signals, right? We've got short-term bearish pressure versus the potential for a really big bullish bounce. So the report now turns to specific price points, the actual battleground where we're going to see which side is winning this tug of war.
This table just perfectly captures the conflict. On the bullish side, you've got the price holding above those long-term averages and those super oversold indicators we just talked about. But on the bearish side, you have that recent price drop and the negative momentum from the MACD. It is a classic standoff between short-term pain and long-term potential.
So these specific numbers? These are the lines in the sand the report identified. Think of support levels, like 432, as a floor the price might bounce off of, and think of resistance levels, like 438, as a ceiling it's going to struggle to break through.
Okay, this brings us to the final verdict. With all this conflicting data, what's the actual trading strategy here? How does the report suggest someone should navigate this whole situation? Well, the report's core strategy is really a 2-pronged approach, and it all depends on your time frame. For short-term traders, it's all about watching for that coiled spring bounce. For long-term investors, it's about seeing if the stock can reclaim that upward momentum.
This slide just lays it all out. The two clear paths forward. Everything hinges on that one pivot point, $432.02. According to this analysis, if the price can stay above that level, the road likely leads up towards 453. But if it breaks below, well, the path could lead all the way down to 418.
So what's the final takeaway from this deep dive? The technicals aren't giving us a simple buy or sell. Instead, they reveal a stock in conflict, a real tug-of-war between short-term bearish pressure and long-term bullish potential. The data has shown us the battleground. The question it leaves for every single investor is this: do you see this crossroads as a moment of risk, or is it a moment of opportunity?